We are now at the halfway mark of our learnings. Up to now, we have focused on the sell side, but now we are going to cross over into the buy side and explore traditional as well as non-traditional buy-side firms and roles. Let's revisit our learning roadmap. We have explored the sell side, origination and primary markets, as well as sales, trading, and research. Now, we are going to step right into the buy side. All buy-side firms share the same overall goal: to earn the best possible returns for their investors and earn associated fees. Essentially, buy-side firms purchase securities and manage them in such a way that they are buying them for prices that are lower than they are selling them at, and repeating this action in high volume and in large magnitude. These buy-side firms, however, have very different missions and mandates that are reflective of their investor base that they are serving and whose money they are managing. In fact, there are enough differences, and moreover, enough similarities in those differences, that people group buy-side firms into two classes: traditional and non-traditional. We will explore this in more detail in this half of the course, but for now, let's start off with some tangible and relatable examples. Here's an aerial map of the two classes. On the traditional side, we have firms like pensions, insurance companies, endowment funds, and mutual funds. On the non-traditional side, we have firms like hedge funds, distressed funds, venture capital, and private equity. Finally, there are family offices, and whether they are considered traditional or non-traditional can vary widely. Let's start exploring the buy side by zooming into the traditional side first. Building off the overview, let's put some real-life names to broader categories. Examples of traditional buy-side firms are asset managers, often called investment managers. You will see that these terms are used mostly interchangeably, like PIMCO or Pacific Investment Management Company. Pension funds, like the National Pension Service in Korea, a scheme that many countries have. Insurance companies like Allianz in Germany. Endowment funds like Harvard University. Family offices like Bezos Expeditions, as well as sovereign wealth funds around the world. The individuals and institutions that give these firms the money to work with and earn returns on are called investors. The aggregate of investors' pooled funds contributes to the assets under management, AUM, which signals how large the firm is. So using the same set of traditional buy-side firms we listed previously, let's scope out from whom they each get their funds. PIMCO, a wide variety of folks from the everyday person to larger professionally organized groups. Pension funds, current workforce, essentially the future retirees and pensioners. Insurance companies, policyholders. Endowment funds, current and future prospective students. Family offices, mostly private family members. Relative to their counterparts on the sell side, whether it is in origination or sales, trading, and research, buy-side firms tend to have less standardization across their organizations as a whole. However, it is still most common to see teams at major firms grouped by asset class, geographic region, or a combination of the two elements. Examples of the most used asset class groupings on the buy side are fixed income, equities, and commodities. Examples of geographic region groupings are North America, Europe, Middle East, and Africa, often called EMEA, Asia Pacific, often called APAC, and emerging markets, often referred to as EM. To give you a practical example, let's say that there is a large U.S. pension fund and that it is a single occupation-based pension, managing all of the retirement income of a state's teachers from kindergarten through and including grade 12. In this hypothetical example, the pension has a team of portfolio managers dedicated to managing a fixed income portfolio called core fixed income. They focused on North American government securities. There is also another team called global equities, and their sole focus is in investing in equities with a focus on North America as well as EMEA. The career path title-wise will be directed at a company-wide level. This means that whether you're an investment analyst in the hypothetical core fixed income group or an investment analyst in global equities, you can expect the exact same type of career title progression. Here is a visual representation of how most trading groups will be physically seated at any buy-side firm. Depending on the size of the firm, the number of people at each rung of this career ladder to the right may differ. However, it is safe to say that you'll always sit together. Your peers and seniors will be seated within very close proximity, and this is supportive of learning through osmosis, which is a phrase you will very often hear in finance. At the most junior level, typically right out of education, undergrad or grad, you'll be hired as an investment analyst. After approximately 2 or 3 years, the next promotion may be to a senior investment analyst. And people might stay in this role for anywhere from 2 to 8 years, after which there may be a series from junior portfolio manager to portfolio manager, and perhaps even senior portfolio manager. Something you may have already noticed is that while there seems to be less rungs than in our sell-side overview, these rungs each span a larger range of time. This is reflective of the type of work that you do and the culture of it all on the buy side. Buy-side roles are much more academic, and the dead giveaway of this with regards to a working environment is just the overall sound level decibel-wise. As a person that has worked on both the buy side and sell side, I would describe buy-side trading floors as very quiet and almost like a library, contrasted to a trading floor on the sell side, which always has a constant humming of noise. A career on the buy side can have a very linear learning path, which is not typically a characteristic of capital markets roles. I say this because a portfolio management team's workflow can be categorized into 3 main buckets, and these buckets do not change as you move up in seniority. Investment analysis, often called investment selection, trade execution, and portfolio management. These are the 3 categories that define the workflow of a portfolio management team. And as you work your way through stages of being an investment analyst through to portfolio manager at a firm, you are essentially moving from doing just one part of this 3-part diagram in a closely supervised or mentored capacity and graduating your way through steps to not only being able to do all 3, but eventually being able to oversee and manage this process. Now, when you look at all 3 of these compartments, investment analysis, trade execution, and portfolio management, it's important to keep in mind that while all 3 of these activities encompass the role of a portfolio management position, it is not necessarily the case that one individual does all 3. This is going to be largely dependent on how the company likes to run their operations. At some buy-side firms, investment analysts and portfolio managers alike may be responsible for just researching and producing the investment strategy and then ensuring that as markets move, that their positions stay in balance, while any and all trade execution is handled by a trader. However, at other firms, a PM may be doing all 3 activities at once. It is a dynamic part of the role that differs from firm to firm. A buy-side portfolio manager's routine is dramatically different in both pace and tone than any role that we have spoken about on the sell side. The daily routine is much more streamlined and focused, as portfolio managers are not constantly reacting to client needs, but instead, they themselves are the client. In addition, a PM's performance is judged by their investors over a much longer time horizon, as they are not in constant interaction with them. Typically, a PM's performance is reviewed at a semi-annual or annual event published in an investor agreement. So on to the day-to-day. A PM's day will typically start around 8 to 8:30 a.m. Their working hours generally start later and end earlier than folks on the sell side. During the morning, a PM's day, much like the pattern you have seen in our previous chapters, is focused on catching up on relevant news headlines. The rest of their day is spent gathering information and analyzing data to inform views, monitoring current active trade positions, and executing trades as well as rebalancing portfolio positions as necessary. Overall, a PM's day consists of filtering out information, thinking critically, and hypothesizing whether or not market consensus is right or wrong and why they think so. Then, with the help of junior team members, they will test and retest their hypothesis by gathering and analyzing data to inform their view. They will debate views with team members until the point where the whole team is collectively confident that there has been sufficient information to confidently act on your thesis. This process is one that takes weeks and is a much longer-term task that is repeated in the course of a career. So with that said, something that portfolio managers generally do very little of is meet with tons of brokers, i.e. salespeople, and read tons and tons of emails. Instead, they selectively reach out to sell-side relationship managers when they need to, and they sift through information to separate the useful from the unimportant. You can probably imagine that a group of people doing these types of activities are not sitting in a room full of buzzing chatter and ringing phones, but rather it's much more representative of an academic setting. It's very, very quiet.